Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Qingdao Port International Co. Limited annual report. Qingdao Port International Co. Limited offers a wide range of businesses and services at the port of Qingdao. The company operates through 5 main segments: container handling, metal ores and coal, liquid bulk, logistics and port value-added services, and port ancillary services. In terms of container handling, the company provides loading and discharging of containers, storage, port management, and other related services. It also offers container freight station, cargo logistics, agency, towing, tallying, facilities construction, and other services. Additionally, Qingdao Port International Co. Limited manufactures port-related equipment and supplies electricity, power, fuel, and other products. The company's metal ores and coal segment involves the handling of metal ores, coal, grains, break bulk, and liquid bulk cargoes. It also provides storage services for these types of cargo. In terms of logistics and port value-added services, Qingdao Port International Co. Limited offers shipping repair and agency, freight forwarding, engineering and construction, cargo agency, property management, media, lightering, fuel storage, oil pipeline transportation, and check and inspection services. Furthermore, the company engages in LNG operations, produces electricity and heat, and sells goods. It also provides security, emergency, and handling services. Overall, Qingdao Port International Co. Limited offers a comprehensive range of businesses and services at the port of Qingdao, making it a key player in the maritime industry. Qingdao Port International Co. Limited maintains a market capitalization of 58 billion, broadly in line with the industry peer group. Qingdao Port International Co. Limited trades at a higher price-to-earnings ratio of 8 times and a higher price-to-book ratio of 0.88 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price to value than it appears. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The balance sheet appears very conservative, with liabilities representing only 25% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.44%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of key performance indicators. On one hand, revenue growth is primarily driven by the container handling and bulk cargo segment, which has seen significant increases in revenue from external customers. This growth can be attributed to several factors, including increased container business volume, optimization of commercial policies, joint marketing with railway companies, addition of new customers in dry and break bulk cargo markets, and deep cultivation of hinterland markets. In addition, the logistics and port ancillary services segment has also experienced revenue growth, largely due to increased CFS business within the region and expansion of agency services, including freight forwarding, vehicle agency, and sea freight booking. These developments have contributed to a substantial increase in revenue from external customers. On the other hand, revenue decline is primarily driven by decreased revenue in liquid bulk cargo handling and ancillary services, which can be attributed to external factors and lower refinery productivity. Furthermore, logistics and port value-added services have also seen a decline in revenue, with decreases of 6.4% and 7.7% respectively. Additionally, revenue from main operations has decreased by $16.5 million, 0.09%, while revenue from other operations has decreased by $118.2 million, 8.76%. These factors have contributed to the overall decline in revenue. The net income of the company experienced a slight decline, decreasing by 0.15% from RMB 5,732,264,385 in 2024 to RMB 5,723,546,579 in 2025. This decrease is notable despite other positive changes in the company's financial performance. On a more encouraging note, the gross profit margin saw an increase of 1.2 percentage points, reaching 36.7% in 2025. This improvement suggests that the company has become more efficient in its production and sales processes, allowing it to maintain higher profit margins on its revenue. The operating profit margin also showed a positive trend, increasing by 0.4 percentage points from 37.3% in 2024 to 37.7% in 2025. This increase indicates that the company's operating expenses have been effectively managed, contributing to improved profitability. The company is indeed generating positive operating cash flow. This can be seen from the net cash inflow from operation activities, which amounts to a significant RMB 5,549 million. Furthermore, the increase in operating profit of RMB 5,272 million also indicates that the company's operations are yielding substantial profits. Additionally, the company has a substantial amount of cash at bank and on hand, totaling RMB 14,486 million. This suggests that the company is financially stable and capable of meeting its obligations, further reinforcing the notion that it is generating positive operating cash flow. The performance of various segments and regions within the company has been mixed, with some areas excelling while others struggled. Segments that performed well include container handling and bulk cargo, which generated significant revenue and net profits from external customers. Logistics and port ancillary services also showed strong results, with substantial revenue and net profit margins. Additionally, investment income from associates and joint ventures contributed positively to the company's overall performance. On the other hand, some segments underperformed significantly. Dry and break bulk cargo handling incurred substantial losses due to high external costs of sales. Port ancillary services faced asset impairment and credit impairment losses. Liquid bulk cargo handling and its associated services also experienced significant declines in performance, with underperformance rates of 29.1% and 22.8%, respectively. Overall, the company's diverse range of segments has yielded varying levels of success, highlighting areas that require improvement and those that are driving growth. The company has a history of paying dividends to its shareholders. According to the provided sources, the total dividend amount distributed was RMB 12,242.0259 million. This indicates that the company has been returning value to its investors through regular dividend payments. The decrease in equity interests of shareholders by RMB 12,254 million further supports this conclusion, as it suggests that a significant portion of the company's profits were distributed to shareholders in the form of dividends. That concludes the financial summary for Qingdao Port International Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.